Hey, and welcome back to Happy Investors. We are going to talk about three stocks from relatively small companies that might have interesting growth potential for the next 6 to 12 months. A disadvantage of researching small cap or small companies is that they often lack a competitive advantage. An advantage, however, is that there are often opportunities to find undervalued stocks because they are simply less researched by the big money. And when companies grow to a certain level, often above the billions, the big money will step in and further growth will be possible purely based on multiple expansion. In other words, a company that currently has a price to earnings ratio of 10 can grow to a price to earnings ratio of 15, simply because larger investments are directed towards it. We have researched these three stocks from countless stocks that we examine every day, and we share our research for free via Happy Investors. But note, of course, purely for inspiration. Moreover, I do not personally invest in these three stocks, as they are not quite interesting enough for me. And that is mainly due to the competitive advantage aspect. The three stocks could outperform this coming year based on the characteristics of the stock. However, for the long term, I find that here and there the business model also lacks a competitive advantage. So for me, as a long-term investment, it is not interesting enough. Only for the coming months, 6 to 12 months, it might be that they achieve high returns. It could be plus 10%, or it could also be plus 100%. But beware, it is a higher risk, so it could also easily go the wrong way. Let's start by taking a look. Plus, you want access to our research on the potentially best companies to invest in. Then check the links in our YouTube description or in the comments. Let's continue. The small company Enova, with shares on the American market, is possibly well positioned and could increase significantly in price. The company itself is not super unique, I should say, and what they primarily do is offer credit, mainly in the USA, but also in Brazil, and they also have an offering for field transfers. So that, yes, there are, of course, PagSeguro is a big, well-known name in Latin America, but so is Pangeo. And they also offer credit business to business with a number of websites. One they have recently launched is On Deck. The company is not super unique, but what I do find a positive advantage when you talk about fundamental analysis is that the CEO, David Fisher, has been in service since 2013. So that's really good. But also, if you look at other management members, we see that they have also been members since 2013. Let's see, 2016. And there are several others who have actually been working at this company for many years. Moreover, David Fisher seems to be quite a smart man, now allowed to accumulate. But anyway, that's all purely text that is stated here. More important, perhaps, are the facts, such as insider ownership, for example. Looking at David Fisher, the CEO, he owns quite a few shares himself. 400,000 converted. Of course, turning the little courtyards is quite a bit of money that he himself possesses. So insider ownership is always very good, and this is more than enough to keep the management satisfied. Let's leave it at that. Recent quarterly figures from the past year are also very good, and we see that there is simply strong momentum. Revenue has increased by about 25%, and of course you can study all the information yourself on Innova's investor relations website. It's also interesting to see that they are buying back quite a few shares, and they have been doing this for several years in a row now. So the buyback program might indicate how much they believe in their own company. So this all looks fairly good, and the characteristics of the stock itself also seem to look good. The current price is 110, and analysts indicate that there is a price target of 130 in the short term. Morningstar provides a lower fair value estimate. However, I have doubts whether they have thoroughly researched the stock. As I mentioned, a small advantage with small companies is that they are often not as thoroughly researched by many analysts, and there might be an opportunity there. We now have a piece of operational valuation, so the price is still below the fair value line, but well above the normal multiple. It is quite important to see that the normal multiple is usually around 6, which is very low. And even in the last 6 years, it was only 7.2. Below, we see estimates for EPS growth from approximately 6 various analysts, which is somewhat on the higher side, at least 15%. By the way, here we see only one analyst, and what we then see is that the price-to-earnings ratio has risen to 11.7. Yes, in relation to the current normal multiple of 7.2, there is almost no price potential. But here, of course, the question is how high it can rise. Can it, for example, maintain that price-to-earnings ratio of 11? 11 is not super high, which would mean that with the current EPS growth, possibly strengthened by more buyback programs, the average return could be as much as 20% per year. And maybe in the short term, it could even be more because it naturally goes with peaks and troughs. But determining a good valuation for this company is very important. and also look at other metrics such as EBITDA. Currently, the price of EBITDA is still relatively low. All in all, it can therefore increase in value both in the short and long term, but it is not really a unique company. So it could very well be that momentum decreases, but apparently they are doing good business, and you can simply see that through certain developments, including, for example, that the revenues are actually starting to increase gradually, but still with quite strong growth. It's not earth-shattering, but it is consistent growth, and that is very important. Therefore, also thoroughly examine the balance sheet yourself, and you can see, for example, when you look at net income, that it was a bit higher in 2020, while the revenue at that time was much lower than it is today. But today's net income is significantly lower. If we look at the valuation, the current price to earnings ratio is around 14, but for next year it is estimated to be around 11. That is still below the sector median. Note that in that sector median there are, of course, also very large companies with a strong moat. That is not the case here. Price to sales, 2.4 is not super low, I would say, for this type of company. Price to cash flow seems very good, but that is a distorted picture. That, of course, has to do with the balance sheet and the income statement as well. Looking at total debt, it is, of course, very high, but yes, they naturally offer enjoyment, so that is very logical. So it can always turn out the wrong way, but this is for financial companies, and I haven't done 100% research, as in that I know the company inside and out. So that is a very important warning. Looking at the growth figures, they seem to look good, based on estimates from management and analysts, combined in this model. And then we see, for example, an e-payment growth of 18% for next year. We also just saw that with FastGrabs. Higher gross margin, the net income margin is actually worse, as we have just seen on the balance sheet, so the income statement, and this actually involves more potential for further growth. So it's interesting to investigate why the net income margin is now lower than, for example, the non-5-year average. And more interestingly, can it grow back to that 25%? Because then they are doing good business. Although I claim that it might not be a great company with a competitive advantage in, for example, their business segments, what we do see is that they are creating a higher return on equity, currently 17%, but the 5-year average is even higher. So there are a number of interesting developments happening. Management is also buying shares. They already own a lot of shares themselves, so skin in the game. So yes, it is quite an interesting small company to investigate. In the very short term, Zexrank indicates a strong buy, and Zexrank mainly looks at short-term developments. Their price target is 117. While the current price is at 110, you see, based on a bit of technical release, I can't say much meaningful about it, except that there is a strong upward trend, so strong momentum. But from time to time, you see significant drops. Minus 75% here, we see about minus 70%, and that wasn't even that long ago, so keep in mind the huge drops. Minus 70% is actually nothing, and the most recent major drop was minus 70% in 2023. Now it is rising quickly, but these kinds of small drops in the short term will undoubtedly occur more often, like around minus 20%, maybe even minus 50%. So the question is, of course, what is the long-term potential? And for that, you need to do very thorough research on this company yourself. But the characteristics of the stock look very good. And for example, it also scores a strong buy on the factor analysis, and you can see it too. Valuation, growth, profitability, momentum, revisions, they all look good. The color green is usually good, but this is all initiated for the short term, and also a 6 string then gives a strong buy for the short term. So it could be that the momentum only continues to increase. A small cap stock that might be really interesting is Wembling.com. This company, in a nutshell, is a kind of affiliated platform that gathers various leads for people who want to play at casinos, and they forward those to casino players. So they essentially provide a bit of matching between supply and demand. And what they themselves indicate is digital marketing services. Well, I personally think that's not too bad. I myself have a lot of experience in building affiliated websites. That's also how my company, Happy Investors, started small, and I can assure you, content is a business where you have to keep going continuously. Soon, Gambling.com will also provide an update on that. They compare themselves to Booking.com or NerdWallet, which essentially match supply and demand. Well, I think Booker.com is a step further, but maybe just NerdWallet might be a good comparison for what gambling does, and Gambling.com just does it for the casinos. That's basically it, and it's nothing more than that. But they are actually doing quite well, and the revenue is starting to rise consistently, so it could be that the stock is very attractive, and we will see that shortly. But first, something about the valuation, for example, we see that the free cash flow has already increased somewhat. Let's say it comes to about 30 million for 2024. The current market cap rounded up is about 600 million. So that means you are paying 20 times the free cash flow. A free cash flow of 20 times is not super high. On the other hand, I don't find it to be a particularly great company, but an advantage is that they have a lot of diversification across many different players. By the way, I personally have a large position in Evolution AB. As those who follow Happy Vessels know, Evolution is a very large company that also offers a kind of white label software for online casinos. And some of the clients we see here are also among them. And you see, it is one of my largest positions at the moment. It's in a downward trend, but I consistently buy more, so it's still at minus 11%, but I am convinced that Evolution is worth more than what we are currently paying. In other words, undervalued. Do you also want to follow our portfolio updates? We publish an update every month. Even when we buy new stocks, we publish that. So make sure to subscribe to our channel, subscribe, and you'll also stay informed about various stock analyses. When we look at gambling.com, they have several websites of this kind that they operate, and there is still some potential for growth because not all states have legalized casinos. What I personally find a big bonus is that the CEO is still, or rather the founder is still the CEO, so founded in 2006, and I find that very good to see. I also find it good to see that the chief operating officer has been employed since 2007, so has basically experienced the same evolution of the company. That is very interesting. I consider that a very big advantage when it comes to fundamental analysis, that the founder is still at the helm. What also struck me, by the way, is that the percentage of insiders is very high. 44%. And another source indicates the same. Let's see, that is Finviz. It indicates that insider ownership is 55%. I still need to thoroughly read the annual reports to verify if it's all correct. I'm also very curious about how much the CEO has and how much, for example, the chief officer has in terms of shares. There are a number of other things they mention on their latest investor relations page. Check that out yourself. You also see they have a lot of content, 34,000 articles. And they also write all kinds of reviews of casinos. And basically, it's just that they combine supply and demand and thus simply promote casinos. Well, one thing is certain, casinos generate a lot of money, and I can confirm that experience. Casinos pay you a lot of money to write a piece of article about them, even if it's just a review. And that is often 3 to 4 times more than what a normal party would be willing to offer. So in terms of profitability, that is quite interesting. Only what I find less interesting is that it just involves... It's actually a middleman, an intermediary. I personally find that less interesting as a revenue model. But well, that's my personal opinion. The company is doing very well if you look at the recent figures. They have recently acquired Ots Holding. The EBITDA growth for 2025 can increase by about 20%, which we'll discuss more shortly. The consensus is a higher price target than at this moment. Let's take a further look at that as well. So the current price is around 17, and the average price target from analysts has now been adjusted upwards to 18. This has been determined by 8 analysts. If we look at the historical valuation, we see that the price-earnings ratio was very low for a while, at least very low, a price-earnings point ratio of 10, but it has eventually increased significantly. And here you see a good example of why sometimes you shouldn't wait too long to buy a stock. And that's the advantage of following stocks over the very long term. From time to time, you see that the valuation is low again. In this case, a price-earnings ratio of 10, super interesting, and I buy more. And then you see that you can already make a profit based solely on a multiple. Well, that multiple has barely increased, so that's less interesting. The normal multiple is 22. I personally find that quite high for a... Yes, let's say an intermediary in this case in terms of earning model. So I wouldn't set it higher than 15 myself. We look at an upside potential if the EPS estimates are accurate. That is, of course, the question. Then you would want to pay a price to earnings ratio of 15. This means that at this price level, the current average return can be about 6% per year. Do you want to pay a higher multiple because you have different insights? For example, that gambling.com could indeed evolve into something like booking.com. I wonder if that is really the case, but well, they are still small, so who knows what is in the pipeline in terms of innovation. Then you might be able to achieve a higher return if you are right. But be aware the EPS estimates here can turn out to be lower or higher. That is, of course, the whole question in investing. Who is right As I said, it's a small company, a small cap, so there aren't many analysts following it yet, which is often a bonus for finding potentially undervalued stocks. And because it is a small cap stock, it doesn't fit into many indexes yet. If it ever grows quickly above a certain market value, it will be included in certain indexes or ETFs, and then it can grow even faster. And the big money can naturally grow towards that as well. All right, if we look at a piece of revenue evolution, we do see an attractive growth. So apparently they are doing things well, and they also indicate in their presentation that yes, there are still quite a few countries in America, or states, I should say, sorry, states in America that have not yet been legalized. So that can be a pan, but with emphasis on a pan, at the moment it is not certain yet, so I would say don't count on it. Looking at the net income, it is also starting to rise now, so that is interesting. Rising trend, visit, neighborhood itself, certainly also the balance sheet and such matters. Well, the current price earnings has indeed increased. For next year, it was estimated to be around 20. I personally find it a bit on the high side. What we are actually seeing is that it is currently strong based on factor analysis. And statistically, this is a very strong model that I can highly recommend for the next 6 to 12 months. And as you can see, I combine it with multiple tools and also 6 rank, which we will look at shortly. But be aware, your success lies in fundamental research, of course. You need to know what the downside potential is, what the risk is, and it seems that gambling can indeed outperform as a stock, despite the slightly higher valuation at the moment. Here, a PE ratio of 0.07 is indicated. Well, that is of course not correct. If we look at, for example, Finviz, another source, it indicates 0.97. A PE ratio below 1 is good. However, if you want a margin of safety, you would prefer to have a PE ratio well below 1. And especially with a not so great company like gambling.com, I would actually want to see a PE ratio well below 1. But it could be that more profit growth is realized than currently expected. I must say it is interesting enough to conduct research on it. Other aspects are less interesting, such as price to sales, paying 5 times the revenue for an affiliate platform. I think more operational knowledge is needed to investigate what the real long-term growth potential is. But one thing is certain, they might benefit from market growth, and that is, of course, always a big advantage. The market cap is relatively small cap, 600 billion total debts are manageable. I have also written that they made an acquisition and they still have some cash on hand. As I mentioned, the founder is still the CEO and has been for a very long time, almost 20 years, so that is a very big rare. We also don't see a lot of insider trading at the moment. As I mentioned, the insider trading is thus. Insider holdings are very high, 44 to 55%. I still need to confirm exactly how much it really is for this CEO. That is not indicated in the sources we currently see. So that always requires manual research. Looking at the growth, and you would want to do something about that, possibly strong growth somewhere. Now that EBITDA growth is expected for next year 41%, and EBIT growth even more. However, another source indicated that it was lower. So here we have to do proper research into what is really the truth. And EPS growth estimates are very high in this data model. So yes, you can imagine that if you see such figures in terms of growth, that it is highest due to the factor analysis. But the question is this correct? Is this correct? Again, I have good experiences with this program, but it is not 100% truth. The metal income margin is attractive, as I mentioned. Casinos are willing to pay a lot for their leads. Those leads naturally generate a lot of money. It is, of course, a casino. They are designed to make a profit. So it is indeed a very interesting sector to earn money in. And gambling.com is therefore not a great company, but it might become a great company, yet it is in a good industry with high profit margins. The resources equity is also remarkably high. So yes, there are indeed many things that are interesting about gambling.com. And perhaps if it experiences a significant price correction in the short term, it could become even more interesting. Zegshenk indicates a buy. Their price target is 18. The current price is 16.7. And if we look based on technical analysis, I don't want to say too much. The company has only been listed since 2021. It has dropped by 50% a few times since then. Actually, even twice. But now it is on a significant upward trend. And just compared to the last drop, it had about a plus 20%. I'm curious, it dropped here by about 10%. It could very well be that a quarterly report disappoints and that it can rise significantly again. The only thing we can say here, based on technical analysis, is 2 things. The momentum is strong and it seems to be getting stronger. And we see that the all-time high, although it's only over the past few years, has been broken. So that is often a sign that it will set a new all-time high, as you can see here. So strong momentum, high on the factor analysis, strong growth potential, and also high profitability. So all in all, light gambling seems quite interesting after the research. A third small company that caught our attention during the daily research we conduct on small companies is Nexon International. This stock currently scores very high on the factor analysis, as we can see here. Now, I personally find this company less interesting. I will also show you why. If you want to know which stocks we do consider the best, check out our website. Every month we publish one stock that we have thoroughly researched and believe can outperform, and then you will find all the analyses we show in these videos, but for a company that we understand very well and where we have been able to assess the risk accurately. If we look at Nexon International, this company, what they do at the core is essentially building a platform that connects both publishers and advertisers. Personally, I don't find this a very interesting business model. There is also a lot of competition, and I don't really see anything distinctive. Looking at the leadership, we see that the CEO has been in service for about 6 years, but I don't find anything remarkable or interesting regarding the leadership team. So for me, it's actually an immediate no-go. It is also comparable to, for example, Perion Network, which also originates from Israel, as Nexon International is from Israel. Yes, as I said, Israel has, as you can see, suffered a disastrous loss recently. How did that happen? I even invested in Perion once, somewhere in 2021. Still managed to achieve a return. Luckily sold in time because I didn't see it coming either. But what happened? The collaboration with Microsoft was put on hold by Microsoft from the Bing search engine, and then many shares of Perion, or many Brike and websites of Perion, actually became, well, obsolete. So that's a very big risk with those kinds of companies. Another thing I don't like about Nexon International is that it seems they don't have much insider ownership. So that's a point. There is also very little coverage from stocks. From the list, the price target is given at 12, but I wonder if that's accurate. Regarding the historical valuation, we can't really say much useful because this stock is also not well included in, for example, fast grabs. So we definitely need to do a lot of manual research here. Only the first signals I pick up from the stock. Fundamentally speaking, what for long-term growth, the business model needs to be much more interesting for me personally, especially in developing a competitive advantage. Note, there are a lot of providers within this sector, and just to mention a great example, that second desk, Paydesk is a great company with great management, a great CEO, much stronger than Nexon International, or for example, Apple Loving. It's somewhat in the same corner. Not exactly the same, but it is a much stronger company. I personally achieved a 1000% return on it in 14 months. Exceptional. Of course, a lot of luck is at the foundation, so let that be clear. But those revenue models were simply much more interesting and important. Potentially a competitive advantage. So that's the first thing you should look at. Do you want to invest in a company? Another notable aspect of Nexon International is the volatility in both revenue and earnings. So we now see that recovery is somewhat coming from last year. But for example, in 2020, the revenue had quickly declined compared to 2019. There is, of course, a good reason for this. But then we see that in 2022, the revenue stabilized and slightly decreased compared to 2021. Well, in 2023, we see almost no revenue growth or a slight decline. And we also see quite a significant difference in profitability. In this case, the cash flow and the net income is then a loss of 21 million, so that's quite a lot. So yes, then you also see larger upward trends emerging, but just based on those last figures, it has decreased by about 50%. But now it is back in strong upward momentum. So the big question is what exactly is happening here? Other important matters include, for example, looking at the cash flow. So if we look at the valuation, the price earnings ratio seems relatively high for next year, 27. If we really look at the price to cash flow, it is 4.6. How does that happen? Well, for that, you go to the cash flow statement. You can also use Yahoo or other sources you have available, and you need to look at what the cash flow from operations is. It seems very high because, for example, there are many depreciations included, but also the addition of goodwill. They made an acquisition somewhere in 2022, as you can see. So goodwill is added there, and there are more of these accounting technical tricks, but cash flow is indeed money. And if we look at the capital expenditure, it is very low. It is an asset-light business model, which is an advantage. So you have a very high free cash flow, and a free cash flow of, let's say, times 5. That's not very expensive. So it could be that the stock is undervalued. However, I have very strong doubts about how it will grow in the long term, and I cannot indicate whether there will be more profit or less next year. So for me, it's definitely a no-go, but maybe you are much smarter than I am, probably so, and can make a better assessment of Nexon International. Why might you want to do that? Well, because the factor analysis indicates that it is a strong buy. This model works very well from my personal experiences. I have been working with this factor analysis from Seeking Alpha for many years. I promote it because I think it's one of the better screeners. I also have some of those affiliate links, but yeah, I don't use them very much. So I just feel that if a company is really good with good products, then I just promote it for free. But it's not 100% truth, so let's make that clear. So you have to do a lot of research and continuously screen daily and then research the individual company. But we see a number of interesting things. The valuation seems to be on the higher side, but the price to cash value is still quite low. What has good numbers? Next year seems to be an EBITDA of -6%, so not that yet. But the cash flow seems to be growing strongly, so the question is, what's going on here? Profitability is not remarkable. The 5-year average profitability is even super poor, 5%. And also in the short term, what we see is an increase in momentum, but I have no idea, to be honest, if this momentum will increase. So the factor analysis indicates a strong buy, so that might be an indication after the research, only if I purely look at the fundamental level, such as the business model. My first impression is I'm not going to invest more time in this. But maybe it is interesting enough for you, because with playing, I know things that cause the momentum to start increasing strongly. So maybe there's something here that I'm overlooking. I would say thank you for watching, and of course, see you next time.